Wall Street starting off the year strong. Futures indicating another rally at the start of trading this morning after the Nasdaq Composite yesterday notched another record close, cracking the 7,000 mark for the first time ever. Many investors are optimistic that this market rally continues into 18. Joining us right now to talk more about that is Oxbow Advisors Managing Partner Ted Oakley. Ted, good to see you. Thanks so much for joining us.
Thanks, Maria.
How do you see this market? You're a registered investment advisor, $1.5 billion in AUM, assets under management. Do you think this momentum continues this year?
Well, it could for a while. You know, things are expensive right now, so when they get expensive, they can get more expensive. And we feel like that's where we are at this point in time. I think I've been through probably as many tops as anybody in the business right now, so they all look similar, and this one is similar to the past in the same way it looks now.
Expensive based on what? Earnings? What's this market trading at? About 17 times earnings?
It is forward earnings, 17.5 to 18 times. But if you look at price to sales, which is something you can't fool with, you know, it's a solid number. It's about the same as it was in 2000. If you look at market cap to GDP, it's back up to where it was in 2000. And people are obviously extremely complacent. They have been for about 15 to 18 months. And so that gives you a perfect storm. Now, it may not happen this month or something, but, you know, we're running about 20% liquid. And that's because we really can't find anything to buy right now.
Ted, one of the interesting things that happened yesterday was the Nasdaq finally topped 7,000. And we're talking about things being expensive. But one of the things I see is that I'm willing to pay, you know, up for a name like Microsoft. I believe you own it at a 30 trailing PE, 25 times going forward, because it's growing at 20%. They have solid cash flows that are recurring revenues. I don't have to worry about upgrade cycles anymore. They're doing well on the cloud. And so where are you looking specifically putting new capital to work? You said you've got 20% about liquid. Where are you going to deploy that capital?
Well, Kevin, when we get late cycle, what we start to do is try to get more conservative. So we'll buy higher quality bonds, we'll buy some treasuries, we'll also buy companies like Microsoft that we think they can increase the dividend. If I have a dividend payer like Microsoft and it can increase the dividend, say 10% over the next 5 years, then I know I'm going to get that component working for me over the next 5 years, even if I don't get a big capital move in the market in general. And those are the kinds of companies we're looking for right now.
Interesting, and I also noticed that you are pretty pro on gold. You're thinking that having a couple liquid positions in gold, whether it be the miners, is a good way to hedge yourself potentially from inflation.
Well, one of the things you look for, and you can look at it from an inflation standpoint, we don't happen to look at it that way. If you look at the cash flow multiples in 2011 on the miners, they were about 3 or 4 times higher than they are right now. So they actually hit their lows in the latter part of 15, early 16. And if you look at the miners that we own, which are Newmont and Agnico Eagle, we think they have a lot of upside over the next 2 to 3 years. If nothing else, from the price of gold moving higher, these companies are working on low capital spending budgets. So we think they'll do well from here.
Hey, Ted, let me ask you, what are the risks? I mean, we are all going along this assumption that the economy continues doing well. I mean, we see this tax plan. We see earnings doing going very strongly. 13 to 15% growth in earnings expected for the S&P 500 in 2018. I know it's hard to see that black swan, but yeah, and consumer confidence slipped to 122.1 last month, down from 128.6 back in November. But where is your worry in terms of what changes the momentum here, changes the direction of this market? Where's the big risk?
Well, most bear markets start not necessarily with something that you see the economy going bad, but they start falling on their own weight. You have so many buyers and you get people so in that you get to a point to where there's nothing underneath, and all of a sudden people will look out 6 to 9 months and they'll start taking money off the table. You can either have that or you can have an outside event a la 1987 or 2001 where you have something you did not expect and comes into the marketplace. But I think this one will come from complacency And it sneaks up on people that, hey, we're probably not going to get what you expected from the tax cuts. And, you know, you can't make a big move in the economy on $80 a month for a family making $60,000.
Well, Ted, the housing bubble and the credit bubble, even in 2007 and 2006, that didn't sneak up on people. People saw it coming, but again, it was almost a mania in terms of people bidding up houses, and it was the same thing during the dot-com bubble, because we talked about it for literally 2 years, that these companies couldn't sustain this. We didn't know when it was going to end, but we knew that it wasn't going to end well. So those were not two shocks, if you will.
We talked about it like we're talking about Bitcoin right now.
Right. That's why I got on Kevin's case earlier about Bitcoin, because we've seen people give in to mania and lose a lot of money.
And that raises such an interesting question, which is, Ted, what if this updraft is different from the rest because the entire market has been lifted, all of these asset classes, by the Fed for so many years? Is that what's different about this time?
That's a good point there.
Well, I think what we're looking at the most, though, and you can look at all these other things, we think the Federal Reserve is a bit off course in that you've got brand new people and you've also got, I think, 3 or 4 empty spots. But you're in a situation where the spread in the curve is only about 55 basis points right now. And one of the best indicators ever has been an inverted yield curve for a recession. And we're getting closer and closer and closer to that. So when you're looking at that, I think you can put that up on top and see that it may not happen tomorrow, but it will eventually have an impact. It has in all the last 10 times. And so I certainly think it will this time as well.
So I know you're in miners and gold, but is there anywhere to hide? Should we see something like that, a significant sell-off?
Well, I know it's controversial, but we have a fairly large position in the 20 and 30-year Treasury. One of the things we decided at the beginning of 17 is that the long rates would not go up. The short rates would. And oddly enough, everybody hid in the 2 to 6 year bonds, which is where they've lost money this year. And we've been in the 15 to 30 year paper, and we've actually made money on those this year. And we think that will be the case because when you have a recession and you tilt that curve enough, that will be a good escape spot for you to own some long treasuries, not short.
All right, we'll be watching that. Ted, good to see you, sir. Thanks so much.
Thank you, Maria.
Ted Oakley there.